You're listening to OPIS Talks, where you'll be in on conversations with insiders in the energy, chemicals, and environmental commodities markets. Guests share insights into the latest trends and innovations, industry challenges, and much more. Let's dive into the conversations that explore where the energy economy is headed, right here on OPIS Talks.
Hey everybody, I'm James Stevenson and welcome to another episode of Tariff Talk. Joining me as usual, Charles Dayton. How's it going, Charles?
Good, James. Good to be here again.
We'll be talking today about some familiar things that we've talked about in recent months, such as obviously the Iran war, which I think we'll probably be talking about for a little while. Also diesel, which obviously flows out of that, or maybe flows out of that is the wrong turn of phrase, but certainly is heavily impacted by it. We're actually going to start with something unusual that happened over the weekend, which is that the United States intervened to support the value of the Japanese yen. This, I think, was a surprise to many. It wasn't a surprise at all to you, Charles, and I think you've written 4 or 5 articles about Japan over the last year, and you've been talking about the possibility of a US intervention to support the yen for some time, and particularly about a month ago, you started getting more and more confident that this would happen. Knowing that the audience might not know the background of all of this, could you just tell us what's happening in Japan and why is it in a situation where the US would even think of doing this kind of action?
Yeah, that's a lot. Let's try and break it down a little bit into different areas, and we can explain it pretty well. So first, Japan is the most indebted major country in the world by far, about 250% debt to GDP, makes our roughly 120% pale in comparison. But at the same time, Japan's managed to enjoy, well, they kind of have to have very low bond yields as well, which seems counterintuitive with a whole lot of debt. But essentially, through yield curve control and other measures, the Bank of Japan has intervened repeatedly to keep bond yields fairly suppressed. And as a result, Japan has been the lender for liquidity for cheap debt for the entire world for several years now. Stepping back a little bit, though, back in the 90s when the Japanese, or more like the 80s, when the Japanese economy was really doing well, Japan realized they were an export-focused economy and they had to kind of have some kind of a guarantee, a safety net to make sure that nothing would ever really affect their currency. Because if you're heavily export focused, then imports get more expensive if your currency weakens. If you're holding a bunch of that 250% of your debt and the currency moves significantly, you either make or lose a lot of money on it. It becomes more risky and volatile as well. You want to keep a fairly subdued currency, let's just put it that way. And the line in the sand for Japan forever has been about 160 yen to the dollar. And so a couple of years ago, when Sanae Takaichi was elected the new prime minister, he was elected with a very populist, very pro-growth, heavy spending agenda. And it became clear that when you're pro-growth and heavy spending and your debt to GDP is 250%, it's difficult for the Bank of Japan to kind of manage everything and put a lid on that. And their actual numbers aren't terrible in their budget. It's just kind of this perception of where things were headed. So as the yen approached 160 yen to the dollar, they didn't want it to weaken very much. The Bank of Japan intervened several times to try and defend that line in the sand. Very extreme jawboning, making threats and lots of very interesting approaches to it. Now, how do you defend a currency? So currencies, like anything else, they obey the laws of supply and demand. So if you want to get the yen to strengthen, you need to pull some of that supply out of the market or increase demand. Bank of Japan can't do a whole lot to increase demand, but they certainly can just go out and buy yen in the open market and pull yen out of supply. Now, how do they do that? If they print money, they're kind of buying Disney bucks with Disney bucks. It's not very effective. So instead, we talked about this war chest of reserves of foreign bonds that they had accumulated over the years. They dip into that, they sell some of it, they use those proceeds in whatever currency to buy yen. And that currency has been the dollar. At our last check, I think Japan had a little bit over $1.3 trillion of global reserves, and 1.2 trillion of that was US bonds. They are the single largest US bondholder outside of the US, single largest foreign country. So if you're Scott Bessent or Donald Trump or anyone else, and you made it very clear, hey, we don't want yields going very high on our treasuries because we're running 6% deficits and we have debt to GDP of 120% ourselves, and Japan is going to go around selling a bunch of bonds and adding that supply to the market, that's going to be bad for bond yields. So basically, Treasury had to act. This is the old adage of, if you owe the bank $1,000, it's your problem. But if you owe them $1 million, it's the bank's problem. In this case, the US was the bank, and a lot of money was tied up in US bonds in Japan. So yeah, to your point, James, we had said all along that we thought the U.S. would intervene so that Japan didn't have to sell these bonds, so that yields wouldn't spike. I think it's always hard to time these things, and the magnitude of it was interesting as well, right? The last time the U.S. intervened in Japan was in 2011 when they actually pushed the value of the yen down. It was about $1 billion of intervention. This time it was 5 to 10 times that. So it's been an interesting journey here. We'll see where this goes forward. But as we all see today, yes, we did call it. And yes, the yen is well below that 160 line in the sand we spoke about before.
Very, very early August at the time of recording, it's 157. So it's been effective. And if you look at a chart, you see it seriously drops during and right after the intervention. Do you think this is it? Do you think this will happen again? And then I know readers might be wondering, well, what other currencies are out there that the US might support, and would they support any other currencies? Thoughts on those?
That's a fair question. My basic take is as long as yields are artificially low, which they continue to be in Japan, we'll continue to see the yen depreciate in this kind of circumstances. I would not be surprised if there's some sort of at least jawboning, if not outright intervention in Japan again, maybe from the US to again prevent them from selling these foreign bond assets that they have. The other part of that, though, is would we see interventions elsewhere? And not in the same scope, I don't think, as going outright buying currency in the open market. There's a very, very significant moral hazard problem here, right? If you're doing activities that help your economy, but weaken your currency, the U.S. buying them and propping it back up again, you don't really learn your lesson and change doing those activities, and that risk, that burden gets shifted to the U.S. and U.S. taxpayers. I'm not sure that Scott Bessent or anyone else really wants to see that going forward. Where he has said he's interested in kind of pushing things is back during COVID when everyone was trying to scramble for dollars, and the easiest way to get liquidity was a similar problem for central banks. They could sell US bonds and they could get dollars as a result. That would have spiked US bond yields during a global pandemic and everything else. The US didn't want that. So the Federal Reserve created what's called the FIMA, F-I-M-A, and it's basically a $60 billion fund from which they could draw money to do currency swaps and things like that. Similar to what we did with Argentina, if you remember that a little while ago, except that what I believe was Treasury focused and not Fed. But Bessent has said he wants that fund a whole lot bigger. It kind of blurs the line between Treasury and Fed. I'm not sure how great of an idea it is from a governance standpoint, but that would probably be the mechanism, is intervene with that fund and some kind of a currency swap situation instead, rather than this wholesale buying it flat out. And we've seen several countries have had their currencies weakening significantly, especially after Iran, right? If you have to buy all of your oil in dollars and the price of oil goes up, you're spending more dollars, we're back to supply and demand again, right? So India, the rupee continues to see new lows pretty much every day. The South Korean won, until the AI kind of boom bust going on there right now, had seen their currency weaken for a couple of years. Turkey continues to see new lows every day. It's not like the US is going to come in and be involved in all of these, but when you have a significant trading partner, you might do it for the stability of the system. And again, to keep your own bonds from adding more supply to an already pretty healthily supplied market.
Let's talk a bit about diesel. I think before we get into diesel, though, I think all of our listeners will be tracking what's happening in, well, not just in Iran and the Gulf, but in the Middle East. You'd written a piece on expressing concern that a blockade of the Strait of Hormuz might spread to Bab el-Mandeb, And it seems that that is happening. And just before recording, you shared a graphic showing the transits through the Strait of the Bab el-Mandeb Strait. That's the southern end of the Red Sea. It looked like it roughly halved. So quite a meaningful impact that the Houthis are having there. But maybe just more generally, flows of crude out of the Gulf, right? We went through that period with the Memorandum of Understanding, and there was a little bit of a rebound of flows, but tell us just what's happening in terms of like actual vessel transits. And you've also been kind of kicking around what other ways are there to get crude out. Maybe give us your thoughts on just how the current flow situation looks, which obviously frames the diesel discussion.
Again, as we know, this all originates in Hormuz, and is it open? Is it not? Are there black convoys sailing through? Are there not? Is it hundreds of millions of barrels? Is it not? All good questions. We're recording this, as you said, on August 4th, and the latest is we're being told there might be some deal to resume navigation, but Iran will be in control, jointly kind of servicing it with Oman. We'll see how that works. But either way, yeah, to your point, even in the best during the memorandum of understanding days, we were probably about half what we were, before the war. And we're talking over 20 million barrels a day of oil coming through Hormuz, and add up all of the different, black AIS transmitters off, everything else, and you're still at a significant deficit. So what have the solutions been? The biggest by far has been this east-west pipeline that the Saudis have over the Arabian Peninsula down to the Red Sea. And then from there, they load at the port of, I believe it's Yanbu. And then from there, it goes out through Hormuz. But the Houthis said, no, we're not letting any Saudi tankers out of here, and we're not letting anything that's associated with Israel out of here. They said a whole lot of different things. It looks like we're back to about where traffic levels were before everyone started rerouting down from Hormuz down there, which is not ideal for the global market for sure. So to your point, kind of what else can be done? Are we going to attack the Houthis again? Probably not. We had this coalition before, bombed the Houthis a lot, and exports never really rebounded through the Bab el-Mandeb. The other option, like we've talked about before, is the Suez is on the other side, but the Suez cannot handle a fully laden VLCC or a very large crude carrier tanker. You can kind of just only fill it about half full, keep your draft a little higher, and you can maybe make it through that way. But I mean, James, even then, the average daily traffic right now for Suez is like 50 to 76 vessels is what I saw. And the absolute all-time record is 89. So you could increase a couple of vessels through there. But not only that, you're going to go through there half full. You're going to top up on the other side, and you've got to send those ballast vessels back as well. So it gets clogged pretty fast. In terms of kind of other options, there is the SUMED pipeline, which is kind of exactly what it sounds like. It goes from the Suez to the Mediterranean, from Red Sea to Mediterranean. It terminates in Alexandria. You can load VLCCs there. It's about 2.5 million barrels or so of capacity, which, the instant reaction you see from the talking heads is, oh, good, another 2.5 million barrels can make it out that way, except we're already using it pretty heavily. I mean, currently, depending on the day, it's between 1.8 and 2 million going through there. So the actual, excess capacity in that, we're talking in the hundreds of thousands. We're not talking, anything very significant for a 20 million barrel disruption out of Hormuz. The only other option, there's an Israeli pipeline as well. No one's really wanted to operate that. A lot of security risks. It's right on the border with Gaza, gets bombed a whole lot. So not sure that happens either. So in short, there aren't a whole lot of really great options. You'd probably go ahead with partially loading if you're going to do VLCCs, getting a few through the Suez, topping them up with piped oil or however you want to do it, and then sailing all the way around the Cape around Africa if you're going to Southeast Asia. Bab el-Mandeb, as we kind of predicted, has turned into a bigger deal than kind of a lot of people thought it would be. And you and I have talked about this at length. It's not just, can the Houthis hit a ship? It's can you get insurance? And right now, Lloyd and several others have said, we don't want to insure going through there. So it's very difficult.
And it doesn't sound like crude flows will re-strengthen imminently, although, as you mentioned, there's potentially a deal talked about, although kind of the cynic in me feels like there's a deal talked about pretty regularly. Obviously, we've started hearing about mining companies actually impacted now in two ways, right? Now, we've known for a while that mining costs are up quite a bit, primarily driven by diesel. But given that we've had a number of earnings calls in the last few weeks, we're actually getting some numbers on that. And it seems like our sort of initial estimates of perhaps 10% were reasonably close. We were hearing higher percentages than that when we were traveling in Jakarta a month or 6 weeks ago, something like that. But not only on the cost side, for the first time, we've had actual availability issues. Those have been in Russia, and they were deep enough. You did a great piece, Charles, that showed that the 11 biggest refineries in Russia had either truncated output or completely cut output, at least for a period. And these are ones that have been targeted by Ukraine. But that manifests in the form of at least coal mining companies in the Kuzbass in central Russia, unable to mine as much as they would like. So we were starting to hear about actual output getting truncated. Russia reacted by banning diesel exports. They were originally through the end of August. They've since been extended, although the ban on diesel, I understand, will be extended as a partial ban through the end of the year. But even a partial ban in a country that exports about 11% of the world's diesel is significant. You did some work to show, I think there was about 30% of the world's diesel exporters are at least impacted, right? Not obviously not, you're not losing all of that. But our view remains that there's still a very meaningful risk around diesel availability. And then secondly, around diesel costs, and I mean, you're constantly making the point that we really have China significantly sitting on the sidelines here. And that's going to be a real headache if China returns to the market, right?
Yeah, so, starting kind of with the diesel issue. So not only do you have Russia, but Russia exports a whole lot of crude oil to other countries as well. Kazakhstan, Kyrgyzstan. Without that Russian oil, they can't refine either. And so on top of that, not only do you have Russia, you've got, if the Middle East itself was kind of its own refining monolith, there would be about 16% of refined products exports just out of the Middle East, and we're seeing heavy curtailments there as well. And you have additionally, India and a few others have done things to restrict exports as well. So when you add it all up, it's absolutely a pretty big issue. And when we look at the crack spreads, the 3-2-1 spread between actual oil and refined products, that crack spread's never been greater. It's for a while last week, the crack spread was higher than the actual Brent crude price. So it was over double the crude oil price. And so, kind of the question is, why is there such a disconnect? Part of it is, again, refinery capacity and everything else. But at the end of the day, everyone getting diesel or gasoline or anything else, they care more about that crack spread than, the actual headline oil price. Although, again, the talking heads might take a lot more, solace in those headline prices. So it's not just a question of, the price at this point, it's a question of can they get it? Not only do we have significant refinery outages, but they had to change the blend in refineries to more jet fuel and less diesel oil. And we had the potential for, a jet fuel shortage here a few months ago. It's kind of a game of whack-a-mole, right? When you change blends to something else, you lose whatever you had before. And China is the massive question mark that floats over all of this. Chinese imports are down something like 40%, I read. It's a massive amount, and China's done more to, balance these markets than kind of everyone else combined. If you look at, IEA announcing they were going to eventually release 400 million barrels, well, depending on the source, and if you use dark vessel trackers and everything else, China's customs says that through only the end of June, James, China had already foregone over 300 million barrels of oil, which is more than what the IEA had released so far. And that's just growing every single day. So we have one of two things happening, right? We don't know what China's storage levels are, but let's put that to the side for a second. We either have a China where all of a sudden oil demand has fallen 40% within the span of a few months, or for many years, China was importing much more than it needed and filling up whatever these underground reserves are. Or China has temporarily, in very, very significantly throttled back on their imports for whatever reasons to help stabilize the market. And if the latter is the case, it can't go on forever, right? Eventually, there has to be a breaking point. And on top of that, once you do start going back to quote unquote normal, you're going to refill those stocks again pretty much as quickly as you can. If anything, what's happened here in the last 5 months, yeah, we're on the fifth month of this war. If what's happened here in the last 5 months or so has been as disruptive as it has been, then you want even more of a stockpile of a security against, those disruptions in the future. So I think the takeaway here is, especially with China, we're managing to meet demand through strategic petroleum reserves across the world, and we're drawing down commercial stocks somewhat. It's much more SPR. We're drawing down refinery inventories and a lot of shadow ones as well. And China's a big part of that. But we're not having a market where supply is meeting demand. We're having one where prices remain low because all of these different stocks are being fed in to kind of keep them low. And ultimately, I don't know when, but that's not sustainable.
A big takeaway is, to our mining sector clients, to please, do what you can to hedge diesel availability. That even if it doesn't end up being a shortage, I think the risk that it could be, I think, is enough reason to at least do something to try to mitigate that risk. Now, speaking of kind of forward expectations, let's wrap the podcast, Charles, just with what's the next topic that you're going to be talking about?
We still have kind of a lot of other things to start to look at. For us, and it matters to the world, today is August 4th when we're recording this. November 6th, 3 months and 2 days, if my
Yep.
math is right, we've got the midterm elections here in the US. And not only, in my view, are the elections an important event, but it's how are we going to position ahead of elections. Now, Trump has come out in his usual Trump fashion, say he doesn't really care if Republicans win because he'll just rule by executive order and things like that, which maybe. I don't think that's true. I think it's kind of a false bravado. And what are we going to do between now and November 6th to give Republicans a better chance? Could be a lot of things, right? If we do start to see prices creep up, or if Trump is finally sick of the actual consumer diesel and gasoline prices being as high as they are, as he says he is, would we see some sort of the U.S. doing their own version of curtailing some exports? I wouldn't put it past something like that to happen. Of course, that just throws, gasoline, no pun intended, on the fire that's going through the rest of the world right now. I think clients need to kind of focus and reframe of, look, we have a soaring stock market. I think we're hitting new highs today. We've got oil. We are up 800 points right now. Yeah, we've got, oil back down to $75 a barrel. But if you believe, Aramco, who talks their own book as they came out today, they think 1.8 billion barrels of oil have been taken out of the market since this war started. At the end of June, IEA was at 1.2. So it's not inconceivable to think that's not terribly far off, probably in between those two bookends. That's a lot of oil, and it's not reflected in price. It's not reflected in demand. It's not reflected in anything. So how are we going to deal with a high inflationary environment going into midterms? I think that's a big way of how people need to think of things. And if you're thinking of ideas of how to deal with this, you're probably going to try to do something to at least calm down Iran before elections. The Scott Bessent comments today may have been that, I don't know. And you're going to do something to try and tamp down prices. We've got an administration that's a big fan of tariffs and restrictions. Again, will oil or refined fuels be involved in that as well? I don't know. I guess we'll see here, but it's a risk I don't think is on many people's radars.
We'll be following it closely, and we'll have a few more episodes of this before the midterms, and certainly what the administration does with respect to Iran, I think, will be massively impactful, and but many other things. I mean, we've had recently new round of tariffs and so forth. So be very interesting to see how that plays out. Let's wrap there. Thank you, Charles. Always appreciate your comments.
Thanks for having me, James. Good to be here.
And we will see all of you next month. Thanks, everyone.
We hope you've enjoyed today's insider conversation on OPIS Talks. Join us next time for a deep dive into another industry insider's world. You can find more OPIS Talks episodes at opisnet.com/podcasts or wherever you listen to your favorite podcasts.